You got oil getting hit pretty hard today, as all asset classes are as well. Goldman, though, saying that commodities will be the best performing asset in 2023. Here's the why. Without sufficient capex to create spare supply capacity, commodities will remain stuck in a state of long-run shortages. With higher and more volatile prices, commodities could return 43% in 2023. Man behind the call, Jeff Currie, Goldman's head of commodities research, joins us now. Jeff, this is a pretty awesomely bold call. Where are we in the cycle that leads you to such bullishness?
Bold call. Let's remember, oil's trading with a 50 vol, so 43% is not even a one standard deviation band.
Fair.
So that's just, remember, we just did $12 to the downside last week and rebounded 6 and down another 2 today. So, and I think, when we go back to our call for a super cycle back in October 2020. You had 42% returns in 2021. So far we're headed towards somewhere around 23, 24% returns in 2022. So this is a continuation of the strong returns that we've been seeing over the last several years. I think bottom line, when we think about what a super cycle really is, it's not this big upward trend in prices that we have envisioned in our heads. It's a sequence of spikes. And because commodity prices perform an economic function, they have to rebalance supply and demand, bring them back in line when they get out of line, like they did at the end of 2021 and the early part of this year. Well, markets are rebalanced right now today. Why? Because China is being locked down. So demand came back down on top of supply, prices collapsed back down. But we have not been investing in supply. Supply is stagnant. So I have to just simply ask, what happens when China, the largest commodity consumer in the world, the largest oil importer in the world, begins to rebound significantly in the first part of next year? It's going to tighten all of these markets tremendously and put a lot of upward pressure on prices. And I think the key point is, you basically have the largest, commodity consumer in the world essentially hibernating over the course of the last year. And that's been hiding a lot of this underinvestment. So really the core point here, underinvestment, weak demand today, but we see sequential growth in 2023. It begins to tighten these markets. Yeah. One last point, inventories have been exhausted. Mm-hmm.
Jeff, let's talk about that China narrative. We are seeing a huge 180. There is a huge U-turn by China. They are reopening. But what comes with that is likely to be a huge pickup in cases. We're starting to see data being crunched on that, and the numbers look pretty bad. How should we be thinking about the China reopening, therefore? Is it going to be similar to the one that we experienced, i.e. stop, start? And kind of how does that work? How does that impact the commodity price?
I think oil is a testament to it. It's going to be a really rough, bumpy start at the very beginning. But so oil is doing like this, each week, big violent moves, because you're going to have your fits and stops and stops. But when you take markets like oil equities or copper, they're more forward-looking. They're looking into March, April of next year. As a result, they don't have that same kind of noise. So it's those high-frequency energy markets like oil. They're going to be particularly impacted with, like you say, a bumpy start to 2023. But as they get past, these hiccups and they begin, you get into the spring, the weather becomes more cooperative, then you start to see much more of a full-blown reopening. Mm-hmm. And that's when you'd expect the markets to get really tight and you really begin to see the upside.
Jeff, what does the curve have to look like for oil for companies to start actually investing more?
There's a lot of focus on the oil curve. It's not the oil curve that is the issue here. What the issue is that the equity prices are so depressed, companies make a better return taking their cash flow and doing share buybacks than they do by putting a drill bit in the ground. And so it's not so much, what's going on in terms of the oil market as much as what's been going on with the equities. The equities are severely depressed when you look at their prices over the course of the last, 4 or 5 years since 2017. Look at a chart of oil price versus oil equity since 2017. The two have completely diverged. And so as a result...
So Jeff, where am I going to get the biggest bang for my buck? Is it going to be in buying commodities or commodity stocks?
history says you're probably going to be better off buying the commodity equities in this environment. They've been undervalued for quite some time. And if we do get that rotation away from the new economy and into the old economy, the vast majority of that capital is going to go into the commodity-related equities. And again, it goes to the point, they are substantially undervalued. I mean, just look at a chart of oil price versus oil equities, going back to 2017 when the divergence began, or, copper price versus, the metals and miners. So, it's not, I think you're going to get great returns in commodities, and they perform a different function than the commodity related equities.
Yeah.
But if you're looking for absolute return, if we get that rotation out of new economy into old economy as we expect, the big benefactor are going to be these commodity related equities.
Hey, Jeff, before we let you go, I have to get your outlook on natural gas, particularly as it comes to Europe. There seems to be an increasing opinion that Europe's going to be able to survive the winter this year. What do your models tell you about it?
Just look at how much of the surplus in gas was eaten through with the cold we've hit. I'm in London right now. I can tell you it's really cold out, and you can see the impact it's having on the gas inventory surplus. It's just making it go away very quickly. So if this weather pattern continues, by January you start to have a pretty significant problem on your hands again. I'm not a weather forecaster, so I get it, but I think the key point here is this market is still on a knife edge equilibrium, and what you're potentially creating here is potential for a pretty significant upside price spike with this cold snap going through right now.